Hi everyone. In today's class, we are going to be dissecting the concept of portfolio theory and analysis, a very practical and interesting concept in strategic financial management or corporate finance. In today's class, we are going to discuss the introduction to portfolio, modern portfolio theory, portfolio risk, portfolio diversification, how to minimize portfolio's risk through diversification. We will also discuss the concept of risk-return trade-off. I will also show you how to estimate portfolio risk, portfolio return, correlation coefficient between securities in the portfolio, and the covariance of the security in the portfolio. Finally, we're also going to have a practical illustration to demonstrate all the learnings in our discussion in today's class. Okay, so let's dive in straight to discussing portfolio theory. What do you understand by portfolio theory? Or what is portfolio? Portfolio represents the collection of several investment instruments, including shares, bonds, energy, commodities, or similar securities. Say, for example, you have basket of investments that include, bonds, shares, energy, commodity, all right, real estate, real estate. You also have in the basket communication, investment in communication, all right. So the collection of all these investment instruments is what is called portfolio. So portfolio is different from portfolio management. Portfolio management represents the art of building and managing several investment instruments that is consistent with the long-term financial goals and risk tolerance of investors. I will check it again. Portfolio management represents the art of building and managing several investment instruments that is consistent with the long-term financial goals and risk tolerance of investor. Of course, in portfolio management, the financial goals and risk tolerance of every rational investor differ because my financial goal may be to erect owner-occupier building. I may want to erect my own building, all right? My financial goal may be that I want to buy a motor vehicle. It could be, my financial goal could be that, I want to invest for the purpose of taking care of my children's education at a later future date. So every individual investors have different reasons or objectives that he or she might want to achieve. So as we have different goals in relation to investments, so also there are different the individual investors also have different risk appetite. So the level of risk that I can take may be different from the level of risk that you can accept. That's our risk appetite. So that's the introduction to portfolio. Let's talk about modern portfolio theory. The modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. The theory stipulates that investors should not only focus on the individual securities in the portfolio, but should also consider how they are related to one another, which is, of course, correlation coefficients in this case. So the theory is based on the assumption that investors are rational and do not like risk, which means that given an investor a high level of risk, the investor will expect the same level of return. And where two securities have the same level of return, the investor will choose the one with a lower risk. This can be shown diagrammatically using the efficient frontier. Now, let's have a graph that will show this. What we are saying is that we want to plot in the efficient frontier, we are going to plot risk versus return to demonstrate the theory of the modern portfolio. Okay, on the horizontal axis, we have the return. On the vertical axis, we have the risk. This is the risk as measured by standard deviation. Here is the return. Okay. Now, let's draw another line. Let's complete the graph. Okay. Let me use another color. Okay. This is return level 1. Let me change the color again. Let's use blue. Return level 2. Then, of course, let's change the color. Let me use this light green. Okay. All right. Then let's join the point of intersection of risk and return. So let's draw the line of the efficient frontier coming from the origin, pass through this and this. Okay. Maybe I need to change this color. Then let me change this color to something else so that it can look different. I'll use red. Okay, let me use this dark color, pink. All right, save from here, yes. Okay then, so back to the normal color that we have, which is deep green. Okay then, so risk and return, we have, this is return level 1, this is return level 2, this is risk level 1, risk level 2. You will notice that the risk and return intercepted at this point. Okay, that's, let's say this is point A. Risk and return also intercepted at this point. Let me write that. Okay. So let's say this is point B. Risk and return also intercepted at this point. Let's say that's point C. Okay, then, of course, this is the origin, 0. Again, the return is on the horizontal axis, while the risk is on the vertical axis. Now, let's explain the graph. Okay, from the graph above, hopefully this will be sufficient. Okay, from the graph above, let me use another color to do that. Let's use color blue or black. Let's use blue. Okay, from the graph above, okay, from this graph, security A and B. Number one, securities A and B lie on the return level 1. Security, let me rewrite this. Security A and B lie on return R1, but at different level of risk D1 and D2. Okay. Point 2. Between security A and B, if you are to select, which one will you select? Remember, security A and B are on the same level of return, but different level of risk. However, security A with a lower risk, relative to security B is preferred. Okay, so we choose security A over security B. Point 3. From this graph, you will notice that security B and C have the same level of risk, D2, but different level of returns. Okay, securities B and C have the same level of risk, but different level of risk D2, but with different level of return R1 and R2. Return R1 and R2. So if you are to select between security B and C, which one will you choose? Certainly, since B and C have the same level of risk, but security C has a higher return. Therefore, security C, point number 4, security C with a higher return will be selected or is preferred, with a higher return is preferred over security B. Okay, That's another point. Now, you will notice that security A and C lies on the efficient frontier. This line is called efficient frontier. Okay? Security A and C lies on the efficient frontiers and dominate security B. So let's put it down. Point number 5. Securities A and C lie on the efficient frontier and dominate security B. Then number 6, from the graph, security A and C are preferred over security B. Securities A and C are preferred over security B. Okay? Then the choice is between security, okay? The choice is between, that's number 7 point. The choice between securities. Before we get to that, because security A and C is preferred over security B, okay, then in that case, where a particular security is preferred over another security, the preferred security is said to possess a stochastic dominance over the other. So which means that security A and C possess a stochastic dominance over security B. Now, the choice is between security A and C. So the choice between securities A and C will depend on the nature, characteristics, and risk tolerance, risk appetites of the investors. Number 9, points that we need to talk about as far as the graph is concerned is that a risk-averse investor, will choose security A. Why a risk aggressive investor will select security C. Okay, because both security A and C lie on the efficient frontier, which are preferred over security B. So this is the explanation of the efficient frontier. Okay, so it is not sufficient. In case you are asked to explain the modern portfolio theory, these are the things you are expected to talk about. So after given the assumptions, which states that a rational investor do not like risk, and then given an investor a high level of risk, we will expect the same level of return. And where true securities have the same level of risk or level of return, we will select the one with a lower risk. So we have used the efficient frontier graph to explain this analogy. Now let's move to the next item. So we are done with modern portfolio theory. So let's talk about portfolio risk. What do you understand by portfolio risk? Portfolio risk is the chance that the actual returns may be different from the expected. You know, when you want to carry out investing decision, you could have estimated what you intend to, the return that you intend to achieve. So the actual may be different from the anticipated return. Therefore, the chance that the actual return may be different from the anticipated or expected return is what is known as a risk. Risk is also a possibility that part or all of the original investments may be lost. Okay? Risk is a possibility that some or the entire original investments may be lost. That's a risk. So in portfolio, risk is measured by standard deviation. And the higher the standard deviation, the higher the risk of the portfolio. Basically, there are two types of risk. We have systematic risk. Okay, let me push it down. Types of risk. Let's talk about types of risk. So like I said, there are basically two types of risk. One is systematic risk, then two, unsystematic risk. What do you mean by systematic risk? The systematic risk is also known as non-specific, general, market-imposed, better, avoidable, and diversifiable, non-diversifiable risk. The systematic risk is a type of risk that affects all the companies or industries in the economy. I repeat, systematic risk is a kind of risk that affects all the companies or industries in the economy. It's a type of risk that investors would like to pay for in order to avoid, but it's not possible because every company, every individual will bear the impact of systematic risk, and that's why it is not diversifiable. What are the events that can cause systematic risk? One is changes in interest rates. Okay. Two, price level changes, that is inflation. 3, economic recession. You remember the economic meltdown, the market crash of 2008, whereby all or some investors lost huge sum of money during the period. Then 4, political turmoil can also cause systematic risk, like what is happening in Israel, Iran or Palestine, what is happening in Russia, between Russia and Ukraine. These are causes of systematic risk. Let's talk about unsystematic risk. The unsystematic risk is also known as specific, non-market imposed, diversifiable, and avoidable risk. It's a kind of risk that is peculiar to a particular company or industry. The events that can cause unsystematic risk include: number 1, regulatory changes; 2, management change; 3, product recall; 4, dependence on limited products; 5, you can also have poor location. If a company is not strategically located, it can result to losses to the company, which is a risk. When there's a product recall, of course, that is peculiar to a particular company. For example, in some years back, about 4 or 5 years ago, Samsung made a recall of one of the Samsung Galaxy model because the phone was generating heat, and the company has to make a recall. So that's a loss to the company because the company has spent money to produce the phones. Now they have to recall from the market. So that's a huge loss. This same loss does not affect other companies in the industry like Apple. So because it was specific to Samsung. So these are some of the examples of unsystematic risk. The next item we want to talk about today is portfolio diversification. Portfolio diversification is a strategy. It's a risk management strategy designed principally to reduce the risk of a portfolio. Diversification will help a rational investor to minimize portfolio risk because it is believed that instead of investing all one's financial resources on a particular security or asset, portfolio diversification is saying that why don't you spread out the investments, the available investments across several assets, such that if one is not doing well, there will be others to fall back on. Most importantly, portfolio diversification is saying that do not put all your eggs in one basket. So the portfolio diversification is designed principally to help a rational investor to avoid a catastrophic financial outcome by combining assets of different that will react to market condition in different ways and at different rates. So by portfolio diversification, volatility will reduce, all right, and that will help the company or the investor to reduce or to minimize the risk of the portfolio. So what we are saying is that, say for example, you have 100 million naira, okay, 100 million naira or any currency that you may want to use. Now, this 100 million naira, if you can spread it across several investments in order to reduce the risk of losses. Say, for example, out of this 100 million naira, about 30 million naira can be invested in shares. Okay? Out of this 100 million, say 20 million naira is invested. 20 million naira is invested in bonds. Okay? Out of the 100 million naira, about 25 million naira can be invested in real estate. Okay? Then the balance of 25 million naira, you can also invest, say for example, you can invest 15 million in energy. Okay, 15 million in energy, and then a balance of 10 million. Okay, the balance of 10 million can be invested in maybe one other alternative investment like private equity. Private equity. All right. So, according to portfolio diversification, it's teaching a rational investor, or a portfolio diversification is designed to help a rational investor to avoid a disastrous financial outcome by spreading the financial resources among competing investments, such that if one area of the investment is bad, of course there will be others to fall back on. So majorly, portfolio diversification is saying that do not put all your eggs in one basket. The essence of spreading the portfolio, the essence of allocating the financial resources among competing assets is to reduce the risk of financial losses, because it is believed that the investment or different asset class will not react to market condition in the same way and at the same rate. So that is essence of portfolio diversification. The bottom line is that do not put all your eggs in one basket. Now, that is portfolio. How do you reduce portfolio risk through diversification? Diversification is an essential part. Diversification is an essential part of risk management, because it helps to reduce portfolio risk. And then, not only that, to reduce the portfolio risk, investors should consider securities that are negatively correlated or assets with no correlation. For example, investors can invest in financial services industry, manufacturing industry, energy industry, communication industry, technology industry. So it is believed that once you spread your investments across, when you diversify your investments across several industries, If a particular industry is volatile, then of course it is believed that other industries where you have investments will be stable, and then that will reduce the risk of your portfolio. That is so. What we are now saying is that to minimize the portfolio risk, you need to invest in securities that are negatively correlated. Like you have here, when you invest in bonds, bonds and shares are not the same. If you invest in financial services industry, you also go to another sector like communication, technology, oil and gas. They are not the same industry. All right. So that is essence of that is how to reduce portfolio risk through diversification. Not only that, in addition, a rational investor can also aim at geographical or international diversification. In fact, international diversification is is a way of diversifying. Is a well is a better way of diversifying investments, because having operation in international markets will help the company to it will help the company or investor to will help the investment to be resilient to gyration. Okay, all right. So that is how to minimize portfolio risk through diversification. Then let's talk about risk return trade-off. What do you understand by risk return trade-off? The risk return trade-off is the positive relationship that exists between expected return and the systematic risk. In an efficient market, it is not possible for a rational investor to want to achieve a high return without expecting a high level of risk. It's not possible. In an efficient market, all relevant information is available. The market participants, they have access to the information, so nothing is hidden. So for one to be able to if you want to earn a higher return, you must be willing to accept a higher risk. So that is the risk return trade-off. The next thing we are going to discuss is how to estimate portfolio risk, portfolio return, correlation coefficient, and the covariance of securities in the portfolio. So let me scroll down so that I can show you how to calculate portfolio risk. Okay. Now, calculating portfolio risk. Portfolio risk is denoted as DB. Remember, I said that standard deviation is used to measure the risk of a portfolio, and the higher the standard deviation, the higher the risk of the portfolio. So, to calculate the portfolio risk, you need to first of all estimate the risk of individual security in the portfolio. So, for individual security, risk of individual security, for risk of individual security, where you have two asset portfolio. Let's say you have security A and B, or security X and Y. That's two assets security or portfolio. So for a two asset portfolio, for a two assets portfolio, say X and Y. So if I want to calculate the risk of security X, remember, risk is measured by standard deviation. So I will say risk of security X will be computed as square root of variance, summation of probability of x minus x bar, okay, square. Then find the square root. So this is the formula for calculating the risk of individual security, just the square root of variance. If you want to do for security y, it should be y minus y bar raised to power 2. So it's still the same thing. All right. So whenever you want to compute the risk of individual security, this is the formula you are supposed to use. Then risk of the portfolio, number B now. For risk of the portfolio, which is denoted as DP. So whenever you want to compute the risk of the portfolio, there are two ways you can do that. You can either use formula, algebraic method to compute it, or you use tabular method. You use a table to do that. So for the table, we are going to use a practical illustration to demonstrate the two. But for now, let me give you the formula. So to compute the risk of the portfolio, denoted as DP, you pick the proportion of the amount invested on security X. This is the proportion of the amount invested on security X. You square the number, you multiply with the variance of security X, plus the proportion of the amount invested on security Y. You square it, multiply by the variance of security Y, plus, because we are talking about two asset portfolio, then multiply by plus 2, multiply by the proportion invested on security X, multiply by standard deviation of security X, multiply by proportion invested on security Y, multiply by the standard deviation of security Y. We need to consider how the security X and Y relate to each other. So we need to consider correlation coefficients. So multiply by the correlation coefficients between security X and Y. So this is the formula. Of course, find the square root. This is the formula for computing the risk of the portfolio. Like I said, you can either use this formula or you use a tabular method to compute it. Either of the two, you are expected to get the same answer. So I will repeat. The WX is the proportion invested on security X. The D square X is the variance of security X. Proportion invested on security Y multiplied by the variance of security Y. Proportion invested on security X, standard deviation of security X. Proportion invested on security Y, standard deviation of security Y. R represents the correlation coefficient between security X and Y. So that is the formula for calculating risk. So let's talk about calculating return. Okay, let's talk about calculating return. Okay, estimating return. Again, just like we have for risk, we are going to compute return of individual security and the return of the portfolio. So return of individual security. Okay. So return of security X will be computed as summation of probability of X. That is, just multiply the probability with the return of individual security. So you sum it up. So that will give you the expected return of security X. If you want to calculate the expected return of security Y, it will be RY bar equal to summation of probability multiplied by Y, that is return of Y. Okay, so that's the formula for calculating expected return of individual security. Then how do you compute the return of the portfolio? The return of the portfolio, calculating, this is A, this is B. Return of the portfolio, or let's say portfolio return, denoted as DP. To compute the portfolio return, RP will be computed as the proportion invested on security X multiplied by the expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. So this is the formula for computing the portfolio return. Remember what I said, I can either use formula or I use tabular method and I will get the same answer. But for now, so we stick to the formula method. When we had illustration, we are going to demonstrate the two. Then number 3, we want to talk about how to estimate correlation coefficients. So what do you mean by correlation coefficients? The correlation coefficient represents the correlation coefficient measures the relationship that exists between securities in the portfolio. Okay? Correlation coefficients measures the relationship that exists between the securities in the portfolio. We have positive correlation, negative correlation, and zero correlation. Okay? However, how do you estimate correlation coefficients? Correlation coefficients. Okay, denoted as R. The correlation coefficient is computed. R will be computed as covariance between security X and Y. Let me shorten the covariance. Covariance between security X and Y divided by the standard deviation of security X multiplied by standard deviation of security Y. Remember what I said. The correlation coefficient measures the relationship that exists between the securities in the portfolio. So to get the correlation coefficients, you multiply, you divide the correlation, the covariance between the security in the portfolio by the standard deviation of each securities. You multiply them. Okay? So this is the formula for calculating correlation coefficients. Before you be able to compute the correlation coefficients, you need to go ahead and compute the covariance between the securities. Covariance between the securities. What do you understand by covariance? Covariance represents the linear relationship or measures the linear relationship between securities or between two variables. Therefore, covariance between security X and Y will be computed as summation of probability multiplied by X minus the X bar. X is a return, is expected, is a difference between X minus X bar is the difference between the expected return and the actual return on security X multiplied by Y minus Y bar, which is the difference between the return of security Y and the actual return of the expected return and the actual return on security Y. Okay, so the summation of the three of them will give the covariance between security X and Y. So these are all the relevant formulas you need to take into consideration whenever you want to determine portfolio risk or portfolio return. Okay, I think we have exhausted all relevant discussion in relation to our course outline. The outline for today's discussion. However, there are other areas in portfolio that you need to take into consideration. For example, you need to research on indifference curve. You need to have the knowledge of the concept of indifference curve, security market line, capital allocation line, or capital market line. All these four items is good for you to have the knowledge, because you don't know where examiner will come out to you, especially for those of you that are preparing for professional exams. Not only that, there are other practical areas in portfolio management, like for portfolio management process. Okay, all of these they are very interesting and practical, but again, our scope for today's class does not get into that. So maybe in the next video we can talk about investment clients. Okay, can talk about investment clients. All right, so let's move on. Now, the next thing we want to do is to have practical illustrations. Let's have practical illustrations. Okay. Yes, so that quickly within the next few minutes we are done. Let's have this illustration. Calafiori is considering investment in one or both of the two security X and Y. You are given the following information. We have information on security X and Y, possible rate of return, probability of occurrence. Now, one thing as an addition, one thing I need to inform you is that at all time, the return of portfolio must be given in percentage. The return of portfolio must be given in percentage, which means that if the return of the security is given in absolute number, in value, then you need to convert it. You need to convert it to a percentage before you begin to compute portfolio risk, portfolio return, and all of that. I repeat, the return of portfolio must always be given in percentage, but if it is given in absolute number, you should convert it to a percentage. I will show you the formula that you can use to convert it. That's one. Then two, where the securities in the portfolio have different probabilities, it means that there is no relationship between the security. That is, R is equal to 0. I repeat, where different probabilities are given for the securities in the portfolio, it means that the securities have no correlation. It means R is equal to 0. So note those two things. Then I said I'm going to I will show you how to convert where you are given the return in naira or in value instead of percentage, because at all time your return should be based on, should be given in percentage. Okay, conversion or how to convert returns in value, return given in value to percentage. Okay, so to convert the return depending on the state of nature given, so the return will be converted to value as value at the end minus value at the beginning over value at the beginning. Okay, all multiplied by 100 over 1. So this is how to convert. the absolute amount of return to percentage. Okay, so let's go back to the question. So I will repeat again. Calafiori is considering investment in one or both of the two security X and Y, and you are given the following information. So information on security X and Y, possible rate of return in percentage, probability of occurrence. You are required to A, calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y, assuming positive correlation between the possible rate of return from the shares comprising the portfolio. B, calculate the expected risk of each security separately and of the portfolio as defined above. For this purpose, the measure of risk may be taken as the standard deviation of probable variances from the expected rate of return. C, outline the objectives of portfolio diversification and explain in general terms why the risk on individual security may differ from that of the portfolio as a whole. So this is the question. What are you supposed to do? In the A requirement, examiner is asking you to calculate expected return of each security separately and for the portfolio comprising 60 for X and 40% for Y. So I want to calculate expected return. So without wasting more time, so solution. Solution number A, we have to calculate expected return of individual security and of the portfolio. So calculating expected return of individual security. So what I will do is that because we are going to use a table to do the two, so I will combine the return and the risk, individual return and the individual risk. So calculating the expected return variance, because there is no way you can calculate risk of individual security without calculating for variance and standard deviation, which is the risk of individual security. So for security, you do for each security separately. So for security X, for me to be able to compute, remember, we said that return is calculated as summation of probability of X, and then variance is computed as X minus X bar for security X minus X bar squared. Okay, probability or multiply by X minus X bar for security X. So let's expand this. So I will then say, I will create a column for state of nature. In the question, examiner did not give us state of nature, even though probability usually come with state of nature. So we have probability, then the return, expected return, expected return. Here is P for security X. Here is X. Okay. Let me cause of space. This is P. This is X. Then we are going to want to expand this variance. So we are going to have expected return, actual return minus the expected return minus the actual return. Okay, X bar, then X minus X bar square then probability of x minus x bar squared. So I will then go back to the question. What are the probabilities? The probability here is for security x is 0.3, 0.4, 0.3, 0.3, 0.4, 0.3. So at all time, your probability must be equal to 1. Okay, if not equal to 1, you need to make it equal to 1. All right, you need to make your probability equal to 1. Okay, then. So let me complete my table first so that we can all right. Okay. What's wrong with you? Okay. Now, the return of security X is 30, 25, 20. Here is 30, 25, 20. Therefore, to get the expected return, you are supposed to multiply the probability with the return. So 0.3 multiplied by 30 equal to 9. Here is 9. 0.4 multiplied by 25 equal to 10. 0.3 multiplied by 20 equal to 6. When you add it up, that's 25. This represents the expected return on security X. To get the variance of security X, you are supposed to expand the formula. Remember, this is the formula for variance. Therefore, the expected return of 30, the minus actual return. So 30 minus 25 will give us 5. 5 times 5 is equal to 5 squared equal to 25. 25 multiplied by 30. 25 multiplied by 30. That's 75. That's 7.5. Okay. Yeah. 0.3 multiplied by 25. That's 7.5. The next one, 0.4 multiplied by the difference between 25 and 25 is 0. 25 minus 25 will give us minus 5. Minus 5 squared is 25. 25 multiplied by 0.3 will give us 7.5. 7.5 plus 7.5 will give us 15. So the variance of security X is 15. Therefore, standard deviation of security X will then be equal to the square root of summation of probability of X minus X bar squared, which is equal to square root of 15. Okay? 15 square root (3.87). Here is equal to 3.87. Okay? So that's the standard deviation of security X. In this case, in the A part, examiner is asking us to calculate the return of the portfolio and the return of individual security, but we have merged A and B together. We separate it later on. So let's assume this is our workings. Then let's compute the return of the portfolio. Return, calculating the return of the portfolio, RP. Okay, the return of the portfolio will be computed as the proportion of the amount invested on security X multiplied by the expected return on security X plus the proportion invested on security Y multiplied by the expected return on security Y. So we are investing 60% on security X, 0.60 multiplied by expected return on security X is 25. Okay, then plus 40% is invested on security Y multiplied by expected return on security Y. Oh, we've not computed the expected return on security Y. So let's quickly do that. In that case, we cannot do this yet. Let's go and compute for Y. Okay. Let's go to the next page. Security Y. Probability return of security Y, then expected return Y minus Y bar, Y minus Y bar square, then probability of Y minus Y bar square. Okay. Then what are the probabilities of security Y? The probability of security Y is 0.2, 0.6, 0.2, 0.2, 0.6, and then 0.20. Then the return of security Y is 50, 30, 10. 50, 30, 10. Here is 50, 30, then 10. So let's get the expected return. Here is 1. Let's complete the table. Okay. Anyways, yeah. Let's complete the table. This is the return of security Y, expected return of security Y. Variance of security Y. Okay, so this is 0.2. So 0.2 multiplied by 50. 0.2 multiplied by 50. Sorry. 0.2 multiplied by 50 equal to 10. Then 0.6 multiplied by 30 equal to 18. 0.2 multiplied by 10 equal to 2. When you add it up, that's 30. So expected return of security Y is 30. So let's calculate variance. To get the variance, I will pick the probability of the first one, which is 0.2 multiplied by, before that, Y minus Y bar. Y bar is 30. Y is 50. So 50 minus 30 will give us 20. 20 squared will give us 400. 400 multiplied by 20% will give us 80. Okay? 30 minus 30 is 0. 10 minus 30 is minus 20. Minus 20 square is 400. 400 multiplied by 0.2 is 80. 80 plus 80 is 160. So the variance of security Y is 160. Therefore, standard deviation of security Y is equal to the square root of the variance of 160, which is equal to 160 squared, 12.65. Here is 12.65. That's the variance of, the standard deviation of security Y. Now that we have computed the return of security Y, return of individual security X, we've also computed the risk of individual security. So let's calculate the return of the portfolio and standard deviation of the portfolio. So the return, calculating return of the portfolio, RP. So the return of the portfolio will be computed as proportion invested on security X multiplied by the expected return on security X plus proportion invested on security Y, expected return on security Y. So this will give us the return of the portfolio. Therefore, RP, we invested 60% on security X. So 0.6 multiplied by the expected return on security X is, expected return on security X is 25. 25 plus, we invested 40% on security Y, multiplied by expected return on security Y, which is 30. Therefore, okay, let me write that. Okay, so the return of the portfolio will then be equal to 0.6 multiplied by, 0.6 multiplied by 25 equal to 15 plus 0.4 multiplied by 30 equal to 12. Therefore, the return of the portfolio is equal to 27. That's the answer. Okay. So let's compute the risk of the portfolio. So calculating the risk of the portfolio. Calculating the risk of the portfolio. All right. So using the formula method, the risk of the portfolio will be computed as the proportion invested on security X, square it, multiplied by the variance of security X plus proportion invested on security Y, square, multiplied by the variance of security Y plus 2, multiplied by the proportion invested on security X, standard deviation of security X, multiplied by proportion invested on security Y, standard deviation of security Y, multiplied by the correlation coefficient between security X and Y. Then we find the square root. So that's the formula for calculating the risk of the portfolio. So we invested 60% on security X, 0.60, then you square it, multiply by the variance of security X. Let's go and pick the number. Variance of security X is 15. Okay. Variance of security Y is 160. 15 plus We invested 40% on security Y, square it, multiply by 160, which is the variance of security Y, plus 2 into 60% invested on security X, multiplied by standard deviation of security X is 3.87. 3.87 is the standard deviation of security X. 3.87. Let me rewrite that. Okay. Multiply by 40% invested on Y, multiply by the standard deviation of security Y. Okay, standard deviation of security Y is 12.65. 12.65 multiplied by R is the correlation coefficient between security X and Y. So in the question, security X and Y have different probability. It means that there is no relationship between security X and Y. So in this case, R is equal to 0. So A will be equal to 0. Then, of course, find the square roots. Therefore, the risk of the portfolio is equal to square root of, bring out the calculator, 0.6 square equal to multiply by 15 equal to 11.04. Here is 11.0403 plus 0.4 square, 0.4 square equal, then multiply by 160 equal to 110.9, 110.9032 plus 2. Since our correlation coefficient is equal to 0, it means that everything you have here, all of them will be equal to 0. So, therefore, risk of the portfolio will then be equal to 11.0403 plus 110.9032 equal the square root of 121.9432, 9435 rather. So square roots. Let's find the square roots. That's 11.04. 11.04 is the risk of the portfolio. The risk of the portfolio is 11.04. Okay, so if I don't want to use formula to get the return and the risk of the portfolio, I can as well use tabular method. To do this, let me see, let's use another page. Alternatively, okay, yeah. So alternatively, I can say so if I want to use tabular method to compute the return of the portfolio and the risk of the portfolio, what I need to do is to go back to the question. What is the probability given for each security? We have 3 probability for security X and 3 probability for security Y. So 3 multiplied by 3 will give us 9. So that means we are going to have 9 possible outcomes. But before then, I need to represent security X and Y with another letter. I will combine it. Therefore, I will say securities, let securities X and Y equal to, you can use M, you can use A. So equal to A. So in this case, I'm going to have possible states or possible outcome. Possible outcome, I will have a column for workings for the returns. Then I will have a column for return, a column for probability, okay, column for probability. Then I'm going to have a column for A minus A bar, A minus A bar square, then column for probability of A minus A bar square. Now, because like I said, each of the securities has three different probability: 0.3, 0.2, 0.6, 0.2, 0.3, 0.4, 0.2. So 3 multiplied by 3 will give us 9 possible outcomes. Therefore, I'm going to have outcome number 1, 2, 3, 4, 5, 6, 7, 8, and 9. So as a result, when I want to compute the return of the security, so I'm supposed to combine, I will combine the return of each of the securities. That will give me the combined returns. But to do this, I will keep the return of one security constant. I will vary the other security. So first thing first, let me load the table. Okay. All right. Oh, I did not include column for expected return. Let me adjust this to accommodate expected return. Okay, so I have the return. Then I will have expected return, then probability. Wow, still need more space. Let me reduce this. Okay, so return, probability, then expected return. Expected return. Okay, actual return minus expected return. You square your results. Then this will be for variance of the portfolio. Okay, then expected return also. I need to total this. Okay, so one more. All right. So, like I said, Instead of having security X and Y, we have represented with A. So here is return. So what we need to do now is to keep the return of one security constant and vary the other securities return. So we're investing 60% on security X multiplied by the return of security X. The return of security X, the first one is 30. The return is 30. So multiply by 30. Let me put it on top because of space. 0.60 multiplied by 30 plus return of security Y. 0.4, we invested 40% on Y multiplied by return of security Y. For the first probability is 50. Is 50. Okay, this is 50. So now, like I said, you are going to keep the return on one security constant. So here will still be 30 plus 0.40 multiplied by the return of the second probability is the return of the second probability is 30 for Y. So the return of Y is changing while we are keeping the return of, is it 30 or 60? Let's check again. Yes, 30. That's 30. Okay, here is 30. Then 0.60 multiplied by 30 plus 0.40 multiplied by 0.40 multiplied by the return of security Y at the last probability, which is 10. Multiplied by 10. Okay. So that's that. So let's complete that. So what I will do here is that I will say 0.6 multiplied by 30. Let me use, open a bracket, 0.6 multiplied by 30, close the bracket, plus, open a bracket, 0.4 multiplied by 50, close the bracket, equal, that's 38. The return is 38. So I will do the second one, which is open a bracket, 0.6 multiplied by 30, close the bracket, plus, open a bracket, 0.4 multiplied by 30, close the bracket, equal, that's 12. 30. The third one, open a bracket, 0.6 multiplied by 30, close the bracket, plus, open a bracket, 0.4 multiplied by 10, close the bracket, equal 22. So that's 22. So the same way you combine the return is the same way you are going to combine the probability. The return of the first probability, the probability of the first return of 30 for X is 0.2. 0.2, is it point, sorry, 0.3. So the probability, the first probability of security Y is 0.2. Therefore, 0.3 multiplied by 0.2. So let me do it this way so that we are not just going to be switching pages. So this is security X, this is security Y, probability. Okay, this one is 0.3, 0.4, then 0.20, 0.6, 0.2, 0.6, then 0.2. Okay, so again, so we are done with that option. So let's move to the next one. You know, we kept the first return of 30 constant all throughout, but we vary the return of security Y. So now that we go back to the question again, the return of the second return for security X is 25. Okay, so we are going to multiply that 25 with the return of Y. So in this case, it will then be equal to the amount proportion invested on X multiplied by 25 of X plus proportion of 40% multiplied by 50 of Y. 0.60 multiplied by 25 plus 0.40 multiplied by 30. 0.60 multiplied by 25 multiplied by 25 plus 0.40 multiplied by 10. Okay, so again, let's do that. Bring out your calculator. I will then say 0.6 multiplied by 25. Oh, sorry, I've not opened. Open a bracket. 0.6 multiplied by 25. Close the bracket plus open a bracket. 0.4 multiplied by 0.5 multiplied by 50. Close the bracket equal to 35. Here is 35. The next one, 0.6 multiplied by 20. Oh, sorry, open a bracket. Open a bracket, 0.6 multiplied by 25. Okay, close the bracket plus open a bracket, 0.4 multiplied by 30. Close the bracket equal to 27. Okay, next one, open a bracket, 0.6 multiplied by 25, close the bracket plus open a bracket, 0.4 multiplied by 10, close the bracket equal 19. So the same way we combined the return is the same way we are going to combine the probability. So we are moving to, you are going to multiply, in the first one, we multiply the first probability of X with the probability of Y, the 3 probability of Y. So the second one, you multiply the probability of X with the entire probability of Y. So let's do that one now. So what we need to do here is that I would then say to get the probability, oh, okay, we've not even done the probability, we'll do that one later. So first thing first, let's complete the return. All right. Again, 0.60 multiplied by the third return of security X is security X is 20. Okay, that's the 20 here. Therefore, 0.6 multiplied by 20. 0.6 multiplied by 20 plus 0.4 multiplied by 50. So what do you get? Open a bracket, 0.6 multiplied by 20, close the bracket, plus open a bracket, 0.4 multiplied by 50, close the bracket, equal to 32. Here is 32. Then 0.60 multiplied by 20 plus 0.40 multiplied by 30. Okay, so what do you have there? Open a bracket, 0.6 multiplied by 20, close the bracket, plus open a bracket, 0.4 multiplied by 30, close the bracket, equal to 24. Then the last one, so this will be 0.6 multiplied by 20 plus, open a bracket, 0.4 multiplied by 10. Okay, so here will be open a bracket, 0.6 multiplied by 20, close the bracket, plus open a bracket, 0.4 multiplied by 10, close the bracket, equal to 16. So we have completed the returns, combined return. So the same way you combine the return is the same way you are going to combine the probability. So the first return is 30 with the probability of 30.3. Then, of course, that's for security X. So for security Y, meaning that you are going to multiply, to combine the probability, you multiply the first probability of X with the entire return of, with the entire probability of Y. Okay, so let's do that. So 0.3 multiplied by, let me push it to this side. So 0.3 multiplied by probability of 0.2 equal to 0.06. So this one will be, okay, yeah, so 0.06. Let me write that 6. Okay, the next one, the return of the second one is 30. Probability of that 30 is still 0.3. Probability of this 30 for Y is 0.6. Therefore, I would then say 0.3 multiplied by 0.6 equal to 0.18. Again, the third one is 0.3 multiplied by 0.2 equal to 0.06. So I'm done with the first one. So I need to multiply this probability of 4.4 with the entire probability of Y. So this one is 0.4 multiplied by 0.2 equal to 0.08. The next one is 0.4 multiplied by 0.6, 0.24. The next one is 0.4 multiplied by 0.2, 0.08. Finally, I need to multiply the 0.2 of X with the entire probability of Y. Therefore, I would then say 0.2 multiplied by point, what's the first probability? Yeah, 0.2 multiplied by 0.2 multiplied by 0.2 equal to 0.04. 0.04, then 0.2 multiplied by 0.6 equal to 0.12. Finally, 0.2 multiplied by 0.2 equal to 0.04. So I'm done with the probability. So I've determined the combined return. I've also determined the combined probability. So all I need to do now is to get the expected return, which is probability multiplied by return. Therefore, I would then say 38 multiplied by 0.06 equal to 2.28. The next one, 30 multiplied by 0.18 equal to 5.4. 22 multiplied by 0.06 equal 1.32. 35 multiplied by 0.08 equal 2.28. Sorry, 2.8. So the next one, which is 27 multiplied by 0.24, that's 6.48. Okay, 6.48. The next one is 19. 19 multiplied by 0.08 equal to 1.52. 32 multiplied by 0.04, 1.28. 24 multiplied by 0.12 equal to 2.28. Then 16 multiplied by 0.04 equal to 0.64. So let's add everything together. That would be the return of the portfolio. Okay, that's the return of the portfolio. So I would then say 0.64 plus 2.28 plus 1.28 plus 1.52 plus 6.48 plus 2.8 plus 1.32 plus 5.4. This is 5.4 plus 2.28. 2.28 equal to, something is missing. So the answer we got here, which is 24, is not correct. I think it's supposed to be 27 because we got 27 here. When we use the formula, we got 27. So the tabular method should also give us 27. I think there's a mix-up somewhere. Let's check the probability of the last three probability. Let's confirm again. So we want to multiply. Oh, this is 0.3, not 0.2. This is where the mistake comes from. This is 0.3. Okay. So 0.3 multiplied by 0.2. So this one is not correct. So 0.3 multiplied by 0.2 will give us 0.06. 0.3 multiplied by 0.6. That will give us 0.18. Then 0.3 multiplied by 0.2 give us 0.06. Okay, that is, if you multiply this 0.3 by this, that's 0.06. 0.3 multiplied by 0.6 will give us 0.18. 0.3 multiplied by 0.2 will give us 0.06. So this is not correct. You need to recompute that. Possibly to be correct now. So bring out the calculator. I would then say 32 multiplied by 0.06 equal, that's 1.92. 1.92. Then 24 multiplied by 0.18 equal to 4.32. Then 16 multiplied by 0.06, that's 0.96. So if you add it up, we should have the same thing as 27 now. Okay then, so let's calculate the variance of the portfolio. So here is A. This is the probability. Therefore, A minus A bar. A bar is 27. So actual return minus expected return. So 38 minus 27. 38 minus 27 equal to 11. So 11 square equal to, 11 square equal to, what am I doing? 11 square, 121. 121 multiplied by probability of 0.06, 7.26. Next one, 30 minus 27 will give us 3. 3 square is equal to 9. So 3 square equal to, 3 square equal to 9, then multiply by the probability of 0.18, 0.18, 1.62, 9, 1.62. The next one, 22 minus 27 will give us minus 5. Minus 5 square will give us 25. So probability of 25, 25 multiplied by probability of 0.06. That's 1.5. The next one, 35 minus 27. Okay, 35 minus 27 equal to 8. Here is 8. 8 square will be 64. Here is 64. Then 64 multiplied by 0.08 equal 5.12. Next one, 27 minus 27 is 0. 19 minus 27, 19 minus 27 will give us minus 8. Minus 8 squared, this is minus 8. This is 64. 64 multiplied by 0.08, that will give us 5.12. 32 minus 27 will give us 5. 5 squared is 25. 25 multiplied by 0.6 will give us 1.5. We've calculated the same thing before. 24 minus 27. Okay, 24 minus 27 will give us minus 3. Minus 3 squared will give us 9. 9 multiplied by 0.18 will give us 1.62. Next one, 16 minus 27. That's 11 minus 11. Minus 11 squared will give us 121. 121 multiplied by 0.06 will give us 7.26. So let's add up all the numbers. So here I have 7.26 plus 1.62 plus 1.5 plus 5.12 plus 5.12 plus 1.5 plus 1.62 plus 7.26 equal to 31. So the variance of the portfolio is 31. Therefore, the risk of the portfolio will then be equal to the square root of the variance of 31. Okay, so square root 5.57. Here is 5.57. Is it 5.57? Yeah. Okay, that's it. So what do we get using the formula? Using the formula, we got 11.04. Then something is wrong somewhere. Should have gotten the same answer. Okay, let's do it again. This is not correct. Let's try it again. So this one is 0.4 squared, 0.4 squared multiplied by 160 equal to 25.6. This is not right. This is 25.6, 25.6. So plus 0. So that's why it's good to be very careful. Okay. So plus 11.0403 equal to square root of 36.6403, which is equal to then square root of that. Still not correct. 6.05. What's the issue? Let's try. Oh, the first, even this one too is not correct. Let's see. 0.6 squared multiplied by 15. That's 5.4. This one should have been 5.4. Wow, so many mistakes. This should have been 5.4 plus 25.6, then plus 0. So this is not correct. So 5.4 plus 25.6, that's 31. 31 squared, 5.57. 5.57, that's the risk of the portfolio. So that's why when you're writing an exam, so it's not too much if you confirm your numbers so that you don't want to avoid a costly mistake being made. All right. So that's that. I think that's end of the question. That's end of the question. Okay. Let's see the C part of the question. Okay. So let's quickly look at the C part of the question. In the number C requirement of the question, okay. In the C part of the question, yes, you are to outline the objectives of portfolio diversification and explain in general terms why the risk of individual security may differ from that of the portfolio as a whole. So let's quickly look at that. The objective of portfolio diversification is to minimize portfolio risk to avoid a catastrophic financial outcome by investing in securities that are negatively correlated or securities with no correlation. The risk of individual security may differ from that of the portfolio as a whole because the risk of individual security is specific, whereas the portfolio risk accounts for total risk. That is both the systematic and then the unsystematic risk. The modern portfolio theory is premised on the assumption that a rational investor do not like risk. That is, given an investor a high level of risk, he will expect the same level of return. As shown in the calculation above, security X has a lower risk of 3.87 relative to security Y with a higher risk of 12.65 or thereabouts. And the return of security X is also, is lower than the return of security Y. So the risk associated with security Y is higher than that of security X. However, the benefit of diversification has reduced the risk of the portfolio as a whole to 5.57 relative to the weighted average of risk of security X and Y. So if you add up the risk of security X plus the risk of security Y divided by 2, so it should be close to around between 8 and 9. Okay, but as a result of diversification, that has reduced to 5.57. So this is that's the question. Maybe in our next class, I can have one more illustration so I can add one more illustration to this. Thank you.